morning. My name is Yale Bach. I'm the president of YH&C Investments based in Las Vegas, Nevada, where it's 110 degrees and the casinos are opening. Anyway, the presentation today is investing strategically and opportunistically in a low-growth environment. The current environment is one where the economy is struggling with low growth, anywhere from 0 to 2% GDP growth in the last 5 years. We've seen all kinds of increased volatility all over the world in currencies and commodities. If you look at oil going from 140 to about 25, you've seen volatility in the yen, in the Brazilian real, in the Canadian loonie, and recently in the British pound. With respect to fixed income instruments, you've got traditionally very low, incredibly low yields all over the world, and in some cases negative yields in Japan, Germany, and Switzerland. Treasuries yield you literally no real yield, return, or a negative real return if you take into consideration inflation. Fixed income instruments that are highly rated are incredibly expensive, typically trading in excess of par. The current environment in equities, last year equities returned about 1.2% on the S&P if you included dividends being reinvested. This year through May, middle of May, the S&P was ahead by 0.41%. The returns have gotten better here in the last 10, 15 days. But halfway through the year, the Dow was ahead by about, I think, 2%, and the NASDAQ was down about 3%, and the S&P was essentially flat. So the current environment has been a struggle for equities. Year to date, the defensive industries have been attractive, and they've attracted a lot of money. You've seen that with utilities, telecom, and anything defense-related. And so the mindset has been to strategically concentrate on the return of capital versus the return on capital. As far as YH&C's approach, we try to be strategic and have a lot of consideration for the client's attitude towards risk. We use a variety of investment styles, and the goal is to attract clients who want to own the instruments and the assets in our portfolios. We want to own what we have invested in. So if you look at some of the characteristics of our equities, we have management teams that have great track records over a long period of time. They have a lot of skin in the game, meaning they have a lot of ownership of the equity. Typically 10%, 15, 20 can be excess of that. And we want to own high-quality businesses. They generate a lot of operating cash flow, free cash flow. They have organic growth. They're operationally focused on incremental improvement, and they have the capacity to engage in M&A transactions that are both slightly accretive or can be transformative. We want to have a clear path of expansion, and some of the models that we run through Covesta are the concentrated long-term GARP and the long-term GARP fund. You can see that through the links on the page, and we've included the investment strategy. A few other characteristics of our equity holdings are we're very concerned with the strategic positioning within an industry. We want them to be a leader. We want them to have structural advantages or logistical advantages. That can be related to their operations, or it could be potentially management related, or it could be tax related. Finally, we want them to be able to profit in difficult circumstances. So if the world goes really sour, say the euro were to disintegrate, these companies, we feel, have the opportunity to take advantage of it. If you want to take a look at our strategy, you see the link there. And finally, if you ever want to get a hold of me, you can email me at information@yhnc.com or call me at 702-350-0024. I really appreciate you taking the time to listen to the presentation and having an interest in my company. Thank you very much, and I hope you have a great day and your investments are successful. Bye-bye.